In this recording, we're going to look at some special issues related to bonds. The first one we want to look at is what if the bonds aren't sold, at the beginning of the year or on the contract date. So recall in example 1, the bonds were issued at par, and they also were dated January 1. So in this illustration, we're going to look at, well, let's assume the bonds were issued on March 31st. So if the bonds were issued at March 31st, 3 months would have gone by, right? January, February, and March. Interest for those 3 months, remember the annual interest is $8,000. So $8,000 times 3 out of 12 months would have been $2,000. So what happens is then the bonds will sell at their sales price or issue price plus accrued interest. So the bonds would have sold for $2,000 accrued interest plus their selling price of $100,000. So the total issue price of the bonds, or the total sales price, would have been $102,000. So let's look at the journal entry, and actually I see I have a mistake here. This should be March 31st for the first year. So on March 31, cash would have come in, that's the $102,000. And then we would credit bonds payable for face value. Now in the past, we would have put the $2,000 credit in as a premium, but the bonds didn't really sell at a premium. They really sold at $2,000 of accrued interest. And so what we're going to do here is credit the interest expense account, which is an odd thing to do, isn't it, when you think about it? So I'm going to set up interest expense, and we know that expenses go up with debits, so it's very odd that we would have a credit in that account. Okay, so here's the amortization schedule for the bonds. That has not changed from our example number 1. This is what we saw in the earlier recording. And there would be interest expense and cash paid throughout. And so these would have been the journal entries. So let's look at, in this first year, there would have been a debit to interest expense of $8,000. Okay? So when we post that, now we're going to end up at the end of the year with $6,000 in interest expense. And that's exactly what we would want for the first year, right? Because in the first year of the $8,000 of interest, we really would have incurred 9 out of 12 months of that, which is $6,000. So interest expense should be $6,000. So we processed it by first, recording the $2,000 issue price related to interest as a negative interest expense, and then just record interest as normal on the payment date, just like we normally would, and we end up with the right amount of expense. So down here, again, recall we would have borrowed $102,000. And the issue price, or the payback, again, is $140, right? That's $8,000 a year plus the $100,000 premium. And so we would have interest expense of $38,000. And, if I put in, when the bonds were issued, we had, when we recorded that, we put in negative interest expense. So I'm going to put that $2,000 in this column, and we'll see then that it will add up to $38,000, and we're in agreement there then. The last topic is the extinguishment of debt. And this is actually retiring the bonds before their maturity date, before they actually mature. So let's look at, we're going to actually use example 2 where the bonds sold at a discount. What if we retired those bonds? What if we go out into the marketplace and buy them back for $99,500? What would be the journal entry? And I want to just kind of talk about it in theory. I mean, essentially we want to remove the carrying value of the bond. So get rid of it. Cash is going to go out, right? So we're going to give up cash in exchange for these bonds, the carrying value of the bonds, and the difference is either a gain or a loss. That should sort of sound a little bit familiar. Same thing if we sold property, plant, and equipment, right? We get rid of the book value of the property, plant, and equipment. Cash comes in instead of out, so cash comes in, and the difference is a gain or loss. So the same thing here. We get rid of carrying value, record the cash, and the difference is a gain or loss. So let's go look at our amortization table at the end of year 3 for the bonds. Okay, so here are our bonds sold at a discount. So at the end of year 3, here's what we've got in the accounts. We have $100,000 of bonds payable, and then we have this discount of $899. So we're going to remove these two accounts. Okay, so we want to remove the carrying value. So we want to reduce bonds payable. So reduce bonds payable. It had $100,000 in it, so debit that. We also want to reduce the discount. The discount's a debit balance, so we credit it to reduce it. Had a balance of $899. So there's step number 1, remove carrying value. Step number 2, record your cash payment. And that's $99,500. So now, I really can just do debits and credit. I actually need a debit of $399 to balance. And that's going to be the loss on redemption of bonds. Okay, so again, we had a carrying value of $99,101. And so I compare that carrying value with the cash given up. So I actually paid more cash than the carrying value, so we have a loss. And let's do the same thing. Instead of looking at example 2, let's do the exact same thing in example 3 where the bonds were sold at a premium, and we're going to have the same price. So let's go look at it. This time, with the bonds sold at a premium at the end of the 3rd year, we have a carrying value of $101,771, and here are the balances in the bonds payable and the premium. So let's go back to our notes and we'll enter in these dollar amounts in our journal entry. So again, we want to get rid of bonds payable. So we want to remove it of $100,000. We want to remove the premium. Premiums have a credit balance, so we have to debit the premium to remove it. $1,771. So that's part 1. Step 2, record the cash payment. $99,500. Whoops, excuse me there. $99,500. And the difference is a gain or loss. So I have more debits than credits. I need a credit to balance, $2,271, and we have a gain on redemption of bonds. Okay, so again, we're seeing in one illustration, we ended up with a loss, and the other one we had a gain. And it's just merely plug in the numbers and you'll be able to determine whether you have a gain or loss.